Hello friends. Somewhere in a government database right now, there may be a number with your name on it. A number that has been quietly reducing your state pension every single week for years without you ever knowing. Not because anyone did anything to you deliberately, because of a mistake. A mistake made decades ago, possibly by an employer who no longer exists, that has never been corrected, and that the DWP will never proactively tell you about. I want to walk you through a real example of how this happens, what it cost one person, and exactly what they did to fix it. And stay until the end, because there is a specific time limit involved that makes this far more urgent than most people realise, and a detail about that time limit that almost nobody knows. Before we get into it, subscribe to this channel and turn on the bell. This is exactly the kind of information I cover. Things buried in government systems that genuinely affect your weekly payment and that nobody rings to explain. Subscribe now and let us get into it. The document at the centre of all this is your national insurance record, available through your personal tax account on gov.uk. And I know what some of you are thinking. I've heard of this. I think I checked it years ago before I retired. What's left to say? Hold on, don't close this video yet. Let us start with what this record actually is. HMRC maintains a permanent record under your national insurance number. Every year of your working life, starting with your very first job, your employer reported your earnings and your national insurance contributions to HMRC, and that data flowed into this record. It tracks every tax year of your career and whether each one counts as a full qualifying year. Your state pension is calculated directly from this record, specifically from the total number of qualifying years you have up to the maximum of 35 needed for the full new state pension. Your online statement is simply a readout of that record. Here is the question I want you to sit with for a second. If you are already receiving the state pension, even if you have been receiving it for years, why would you need to look at this now? The amount was already calculated. The payment arrives every 4 weeks like clockwork. Why look backward? Because the record is not always correct. And an error in it does not just sit there harmlessly, it permanently reduces your weekly payment, whether you are still working or have been retired for over a decade. Here is a real-world example of how this happens. Someone who had been retired for several years checked their national insurance record out of curiosity. Scrolling through their history, they found 2 consecutive years in the late 1990s marked as not full, meaning they did not count as complete qualifying years. They knew they had been working full-time during exactly that period, earning well above the threshold. What happened was straightforward. The employer had run into financial difficulty, mishandled its payroll reporting to HMRC, and eventually closed down. The contributions were deducted from the person's wages at the time. They could see it on old payslips, but the record showing those contributions had reached HMRC was incomplete. They gathered their old P60 forms for those years, contacted HMRC's National Insurance Contributions Office with the evidence, and the record was corrected. Their weekly state pension increased permanently, and because the correction affected years that had already been used to calculate their pension, they also received a backdated lump sum covering the underpayment since they started claiming. So here is exactly what to look for when you open your record on gov.uk. You will see a year-by-year breakdown going back to when you started working, with each year marked as either a full qualifying year or not full. If you see a year marked as not full, where you know you were working and earning above the national insurance threshold, that is worth pursuing. Remember, your pension is based on reaching 35 qualifying years. If one of those years that should count as full is instead marked as not full, your weekly payment is permanently lower because of it, by approximately £6.89 per week for each missing qualifying year. Now here is the part that creates real urgency, the part most people genuinely do not know. For voluntary contributions to fill a gap, the standard rule is that you can only go back 6 tax years. After that, the opportunity to pay voluntarily to fill that specific gap closes permanently under the normal rules. But, and this is the important distinction, that 6-year rule applies to filling a genuine gap when no contributions were made. It does not apply in the same way to correcting an error, where contributions were made but HMRC's record does not reflect it correctly. If the gap in your record exists because your employer failed to report your contributions properly, a clerical error, a payroll mistake, a company that mishandled its filings before closing down, HMRC can investigate and correct the record regardless of how long ago it happened, provided you can support your claim with evidence. The honest summary is this: the sooner you check and raise a correction, the easier the process tends to be. The longer you wait, the more HMRC may ask you to provide. But having documentation in hand, even from decades ago, generally gets the job done. This is exactly why the smart move is not to wait. The longer those old P60s and payslips sit in a drawer or a loft, the more likely they are to get lost, damaged, or become unreadable. Check your record now, whilst you still have time to gather what you need without a fight. So what do you actually do if you find a year that looks wrong? Step 1. Gather your proof. The strongest evidence is an original P60, which shows your total pay and the national insurance deducted for that tax year. If you do not have a P60, old payslips covering the relevant period work too, particularly if they show national insurance being deducted consistently. Bank statements showing regular salary payments from that employer can also support your case if other documents are not available. Step 2. Contact HMRCs. National Insurance Contributions Office on 03002 003 500 or write to them with your evidence. Explain which tax year or years you believe are incorrect and why. For example, that you were employed full-time during that period and your payslips show national insurance was deducted, but the year shows as not full on your record. Include copies of your evidence, not originals. HMRC is required to investigate. If they confirm the error, they update your record and recalculate your state pension going forward. And if you are already claiming, any backdated underpayment is paid as a lump sum. What if the company you worked for no longer exists, closed down, gone into liquidation, the original owners untraceable? You still have options. HMRC retains employer payroll submissions for many years independently of whether the employer still exists, and can often verify historic contributions from their own records even without your involvement. If you have no documents at all, HMRC can still investigate using what they hold. But providing whatever you do have, even partial records, speeds the process up considerably. One more thing, specifically for anyone currently working or within a few years of state pension age. Do not wait until you claim to look at this. Check your record now and check it every year or two. If your current employer is deducting national insurance from your payslip, but last year shows as not full on your record, that is something you can raise with your payroll department tomorrow, whilst the company still exists and the people who can fix the mistake still work there. Finding this out 15 years from now, after the company is gone, is a much harder fight. And a note for anyone watching this with elderly parents or relatives who are not comfortable with computers. This is something you can do for them in about 20 minutes. Sit down together, help them log in to their personal tax account on gov.uk using their government gateway details, and pull up their national insurance record. Compare it against whatever old paperwork they have. Finding one incorrect year and getting it corrected could mean an extra £6.89 a week on a fixed income, over £358 a year, every year for the rest of their life, plus a potential backdated lump sum. That is not a small thing. So here is the summary. Your state pension is calculated from your national insurance record, and that record can contain real errors, even from decades ago. Open your personal tax account on gov.uk and check every tax year for ones marked as not full where you know you were working. The standard 6-year rule applies to filling genuine gaps voluntarily, but correcting an actual error in the record, caused by an employer's mistake, is possible well beyond that time frame with the right evidence. The sooner you check, the easier it is. Gather your P60s and payslips and contact HMRC's National Insurance Contributions Office on 03002 003 500 if you find something wrong. And if the employer no longer exists, HMRC can often verify historic contributions from their own records. Subscribe. Share this with someone you know who is on the state pension, especially if they have been retired for years and have never checked this. I will see you in the next one.